Guys, we have to break down some blue chips. I want to go over 5 blue chip stocks that I'm looking at right now as we're wrapping up 2021 and we're heading into the brand new year. New year, new me, baby. Just kidding. It's going to be the same old me, but I want to break down 5 blue chip stocks heading into 2022. We're going to break down some numbers, revenue, earnings, dividend, P ratios. We're going to break down some charts, so sit back, relax, hit the like button, subscribe. Check out my Patreon down below if you guys want all my moves in the markets, buys, sells, call outs, all that good stuff. And you could also get 50 free bucks from M1 Finance and 2 stocks from Webull, up to $1,600. All of those are linked down below. And with that being said, let's get into it with stock number 1. Actually, before we even get into that, the 5 stocks, let's go over what a blue chip stock is in general. And this is a definition pulled straight from Investopedia. So are you guys ready? Drum roll, please. A blue chip stock is a huge company with an excellent reputation. These are typically large, well-established, and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. A blue chip stock typically has a market cap in the billions, is generally the market leader or among the top 3 companies in its sector, and is more often than not a household name. So essentially, a blue chip company is a company that's dependable, strong reputation. You know it. I know it in terms of being able to recognize the company, and they do pretty well, and they're a very big company. That, in a nutshell, is what a blue chip stock, blue chip company is. So with that being said, now that we got the definition out of the way for all the viewers out there, let's now talk about the 5 blue chip stocks that I'm looking at, 2 of which I own, 3 of which I don't own, if you guys can do the math there. And I'm looking to maybe buy these heading into 2022. So number 1 is Disney, ticker symbol DIS, and this one, full disclosure, is one of the ones that I do own. And if you guys are in my Patreon, you saw that I actually bought more Disney. I think it was on Thursday, or maybe it was yesterday on Friday, the day before I'm filming this video, if you guys are watching it in the future. So Disney at this point in time is a $265 billion market cap. They pay no dividend. If you guys remember, they actually cut their dividend to feed the growth of the company, because if you guys didn't know, dividends are paid when they can't necessarily use that money to grow the company from the inside, right? Invest in research and development, create new products. And in this case, Disney was heavily investing and still investing in its streaming services, primarily Disney Plus. So you notice with a lot of these big companies, older, more value-oriented companies, they pay dividends because they can't take that money and grow the business from the inside. So Disney, I actually agree with this move. They had about, I think it was like a 2% dividend. They cut it. No dividend as of now. They're taking that money, reinvesting in the business. That's great. And in the trailing 12 months prior to me filming this video, they've made about $67 billion on the top line, which is $67 billion in revenue, which is great, and only $2 billion in net income. So we all know at this point that they got hit very hard from the CV, right? The parks, the cruises, it got hit very hard. So they lost a lot of money. Their EPS, or rather their PE, is extremely high because the numbers are all distorted right now. So I'm not paying too close attention to the net income, although I do believe it will slowly come back up over the coming years. And when it comes to the chart here on Disney on the 3-year, it is down about 20%, I believe. Actually, no, I'm wrong. 30% is what it's down. So it's in a bear market, and we're approaching a critical 180 moving average support on this 3-year chart, which, again, I bought more Disney here recently. excuse me, guys, recently, I believe at about 147. So, yeah, Disney is a buy for me here. For me, you guys must always do your own research, but I'm looking at it heading into 2022 with all the growth prospects they have, parks getting back to normal, cruise lines back to normal soon, hopefully. I think Disney's great. So, stock number 2 is Visa, which, full disclosure, I do not own Visa. And just like Disney, a very similar chart pattern here I'm seeing on the 3-year chart, that is, Visa's approaching a long-term moving average support, which is right by this 180 SMA, and now we're trading right by it at about 190. The moving average is at 185, so sure, it could go down a little bit more to touch the moving average, but pretty much we're at a buy zone now where buyers did step in back in the March crash of 2020 at about 130, and even before that. So at this point, Visa is down 25%, also in a bear market like Disney, and their market cap's actually a lot bigger than Disney's. Disney's is $265 billion, Visa's is $431 billion, and their trailing 12-month PE is a 34. So maybe, I don't want to say it's richly valued to the point where it's ridiculously overexpensive. I don't think it is, but in that same breath, I'm not going to say it's a great deal or even at fair value here. I kind of think it's hovering between fair value, probably a little bit above fair value, quite honestly, and still a bit frothy. If the P was like a 20 or 25, that'd be different, but a 34, it's still a little bit hot, but it's a decent chart, right? And on top of that, they pay a 76.76% dividend yield. Imagine a 76% dividend yield. That'd be insane. So they pay under 1% in dividends, and they make a lot of money, guys, on the bottom line. They did $24 billion in revenue trailing 12 months and $12 billion in net income. So they're making a lot of money, on the bottom line. So if you're looking for a super profitable business, Visa, it's Visa. Let's put it that way. They make a lot of money on the bottom line. So I don't own Visa, but I plan on maybe picking it up in 2022, especially as a swing trade, right? If it comes to a long-term investment, probably not going to look at Visa because I already own MasterCard. There's no point, in my opinion, in owning both. But look, as a swing, I think it's a nice blue chip play heading into this new year. Intel, INTC, full disclosure, I own Intel. They have a $200 billion market cap. Their PE is at 9.5 in the trailing 12 months, which is very low. So this one's way under what the S&P's at right now, which I believe is a 25, 27 PE, something like that. So Intel is very undervalued, in my personal opinion, extremely, and that's why I own it. The dividend yield is a 2.81%, so a nice juicy dividend. It's not a 5-6%, which is a big dividend, but it's not under 1% like Visa. It's right smack dab in the middle, which is great, around 3%. And this business is surprisingly profitable. It's not surprisingly profitable. It's been profitable, but it's a $78.4 billion. They did $78.4 billion trailing 12-month revenue and $21 billion net income. So not as profitable as Visa percentage-wise, but they're still pulling in $21 billion net income, which is solid. So they're churning out money. They're making money, and this stock is down about 30% from all-time highs. It's in a bear market. We're more towards the bottom of this wedge here. We're holding an uptrend, and I personally own shares, like I said, but I didn't tell you the price. I'll tell you now. I own them at about $54, $55 per share, and I do plan on buying more here heading into 2022. So Intel, chip maker, a lot of people think, oh, it's over. Intel's in the garbage. AMD, NVIDIA, they're the future, which they are the future, no doubt about it, but I think Intel has part of that future as well, and when it comes to valuation, that's what people don't realize, especially when you're looking at a longer-term play, not necessarily a swing, but with longer-term plays, valuation is critical. What you're paying is so important, and NVIDIA and AMD, in my opinion, they're a bit lofty, a bit frothy right now, where Intel, not so much. So I like Intel here 100% heading into 2022. Caterpillar is another one that I'm looking at here. They have a $106 billion market cap, a 21 PE, which is not that bad. Honestly, I would like to see it. For me to buy Caterpillar long term, I'd want a PE at about 15. To be completely honest, maybe 13 and 15. I think that would be very solid. But 21 is not. It's not like it's horrible. It's not like it's extremely inflated. If it was a 30 or 35, that'd be ridiculous for Caterpillar. But a 21, decent. I would like it way more at 13, 15. But overall, at this point, it's decent. $106 billion market cap, 2.26% dividend yield. They did $48 billion trailing 12-month revenue and about $3 billion net income. So they're not the most profitable on the bottom line as some other companies, but hey, they're a blue chip stock, very solid company long term. And on top of that, they're trading down a very good chunk, 20%. They're down 20%. They're in a bear market. And with the whole infrastructure bill, you guys know what I'm talking about. I think Caterpillar will benefit over the next year, 2, 3 years. So if you have a longer time horizon, I'm talking to myself as well here, Caterpillar will be nice. And I'm not buying it quite yet, but if it does start bleeding down to that 180 moving average on this 3-year chart, anywhere from 150, 60, maybe even 70, get that P down a bit, 15, 16 PE, that is where I'm going to be buying Caterpillar. And the last one for today is Walmart, which admittedly, if we're looking at valuation metrics, I think Walmart is overvalued here. And we'll talk about that in a second. But if you're looking at the chart's great. So that's the big difference with swing trading and with long-term investing, right? You can use charts in long-term investing, but in my opinion, they're mostly for, doing some short-term trades. So I'm looking at Walmart more as a trade heading into 2022. And if that P gets down, hey, maybe I'll look at it as a longer-term investment. But as of now, the PE is too hot. The PE, you might get your socks blown off on this, guys. It's a 48 PE, trailing 12 months, and it's a $383 million or billion dollar market cap, and a 1.6% dividend yield, $570 billion in revenue. Guys, the market cap is $380 billion. They did $570 billion in revenue, which is just insanity, guys. That's so much revenue in the trailing 12 months, and only $13.5 billion in net income. And going back to that PE, this is insane. And if you guys didn't know, PE ratio is important when determining if a stock's overvalued or undervalued, or if it's worth paying the price, because companies that have a lot of growth, they have a higher P/E ratio. Companies that don't have much growth, lower P/E ratio. And the thing is, the crazy thing is here, Walmart's growth is not great. They're growing sometimes 2% a year revenue growth, sometimes 3%, sometimes 1%. I think this past year it was like 5 or 6%. So that little amount of growth is not worth paying a 50 PE. If the PE was a 15 or a 20, that would be a different story. But a 50, it's too hot. So overall, that's pretty much it. The charts here look pretty good on Walmart, but I would not like it here as a long-term play. That's just me. And that's it. Walmart, Disney, Visa, Intel, Caterpillar, those are 5 heading into 2022. I hope you guys enjoyed this video, got some value, some insight from it, learned something or two. If you did, let me know down below in the comments. Make sure to hit the like button as well while you're at it, and make sure to subscribe. Hit that notification bell, and check out my Patreon if you want all my buys, sells, call outs, morning update videos, more access to me throughout the day as well. All of that's on Patreon, link down below. All you guys could also get 50 free bucks from M1 Finance, 2 stocks from Webull, up to $1,600. All of those are down below as well. And with that being said, hope you guys enjoyed the video. I'll catch you all in the next one. Keep crushing the markets. Stay safe out there. Peace out.